So welcome back once again. Now in the previous two sections, we have learned about some simple trading strategies and we have also learned about spreads, hedges and covered calls. But you see those strategies were basically suitable for a bull market. That means when prices were in an uptrend, and they were also suitable for a bear market. That means when the prices were going down. In both these markets, the strategies which we have studied were good enough. But then what do you do when the markets are either moving sideways, they are neutral, or they are very volatile? What do you do under such conditions? If the markets are neutral, then you may have to adopt some neutral market strategies like iron condor, also called as a short iron condor, or maybe a short iron fly, also called as an iron butterfly, or you may have to adopt a butterfly spread strategy. Don't worry about the names, I will be explaining all these things in detail. Here I am just trying to list out the names. Alright. So short straddle and short strangle are other two, neutral market strategies. But if the markets are volatile or turbulent, in that case you may have to go for a long straddle or a long strangle. Alright. So in this section, we shall try and understand these advanced strategies, but we will not be going in a sequence. We shall try to understand the simpler ones first. Among the advanced strategies also, the ones which are simpler, we will try and understand them first, and then we will gradually build upon them to understand the more complex ones. Alright. Now, before we proceed further, just give it a thought that when your analysis tells you that the markets are moving up, that means it is a bull market, then you know that you have to go long. But at the same time, you protect yourself from the market coming down. You may take some positions to protect your profits or to protect yourself from coming down. But ultimately, in a bull market, the profits are made only if the markets goes up. If they go down, you may minimize your losses, but you won't make a profit with the strategies which we have studied so far. And similarly, when you analyze or when your analysis tells you that the markets are in a downtrend, then you know clearly that you have to go short. Still, you will take some positions to protect yourself from an up move just in case the market turns around and starts going up. You will take some measures to minimize your losses, but ultimately you will benefit only if the market goes down. That was about the bull market and the bear market, alright? But if the markets are moving sideways or if the markets are volatile, then you are betting on both sides of the coin. As a trader, you want to benefit from the up move also and you want to benefit from the down move also. Both the sides of coin you want to have it. Alright. If the market is rising or whether the market is falling, as a trader, you make an attempt to profit in both of them. So in such cases, you have to strike a balance between two things. You see, you can't have cake in both your hands. You have to strike a balance. Balance among what? Balance between the amount of profit and the probability of profit or the POP or the chances of getting that profit. What does it mean? What do I mean when we say this? Let us say that you take a trade and your analysis is telling you that if the trade becomes successful, the maximum profit that you can get is 20,000. Alright, $20,000 or rupees or real, just don't bother about the currency, try and understand the concept. Alright, and your analysis also tells you that just in case the trade fails, then the maximum loss that you will sustain will be 80,000. If it is profit, it will be maximum 20, but if it goes wrong, the loss can be even up to 80,000. So what does it mean? It means that the amount of profit or likely profit is less. If the amount of profit is less, then it is very likely that the probability or the chances of getting that profit will be high. It may be as high as 80%. 8 out of 10 times you may succeed if your strategy is based on this. Alright? But suppose if you take a trade and your analysis tells you that if the trade is successful, the maximum profit can be up to 80,000 rupees or $80,000. But just in case the trade fails, then the maximum loss will be only 20,000, opposite of the earlier case. Here, the amount of profit can be more, but if the trade goes wrong, then the loss will be very small. If this is the case, what does it mean? It means that the amount of profit is high, and if that be so, then it is very likely that the probability or the chances of getting that profit will be low. It may be just 20%. So 1 out of 5 times you may succeed in such a trade. Alright? It can never happen that the amount of profit is also very high and the probability of getting that profit is also very high. You have to be realistic in the stock market. You can't have a cake in your mouth as well as in your hand, or you can't have cake in both your hands, as they say it. All right. So I hope I have been able to make this point very clear. All right.